Hello everybody, this is the second part of chapter 0. So in the first part we've discussed two ways companies can access capital, which is through debt or through equity, and we've discussed the debt part mainly. So we discussed bonds and loans as two ways of accessing debt capital. So now we're going to go through the equity type equity approach to get some capital for companies. So, uh, what is equity? Equity is a title of ownership of a share of the company. And unlike debt, so for example, bonds or loans, uh, equity, so for example, stocks, they have no expiry date. So if you contract a loan, there's a maturity date where you need to reimburse all amounts outstanding at that date, whereas for equity, there's no such maturity or expiry date. So the equity or stock would expire when the company terminates. So either through bankruptcy or when it decides to liquidate its assets. So there are many types of um, equity. There are common stocks, preferred stocks, and private equity, which we will discuss subsequently. Okay, so oops, sorry about that. So the value of equity, so for example, of a stock, consists in the claim to future dividends paid by the company to shareholders. So if you are a shareholder, so if you hold equity in a company, then in the future, the company is expected to provide some payments to owners of the company, and such payments are called dividends. So these payments come from profits made from the company, and the company is expected to redistribute its profits to the owners. However, paying dividends is never mandatory for a company. So if a company does not repay its pay dividends at some point in time, there's no legal consequence, which is different from debt. So if you don't repay your debt, well, you go into bankruptcy or into litigation. Whereas if you don't pay dividends to owners of the company, there are no legal consequences. Okay, so in case of bankruptcy, of course, debt holders will be repaid before equity holders. So they have a higher priority. So if the company goes bankrupt, then it will repay its debt before redistributing the value of other assets to the owners of the company. So because shareholders or equity holders, they cannot enforce payments from the corporation, they have a higher risk in some sense. So to be compensated for that, they will have a higher expected return. So they will expect more return than if they were uh, lenders and they would be owners of the debt. Okay, so equity in average pays more than debt. So we discuss a few types of equity. The most well-known type of equity is common stocks. Okay, so these are titles of ownership for large corporations that are typically traded openly on public exchanges. So if you hold a common stock to a company, you're entitled to future dividend payments made by the company, but you're also entitled to a vote to elect the firm's board of directors. So what's the board of director? It's the entity which uh, elects its president and is responsible to oversee the work of executives at the company. So it provides like holding an equity, because you're able to vote for the board of director, you hold some indirect control over the firm, because you elect the board of director. The board of director decides the identity of the president, and then the president hires all other executives and etc. So the board, as we said, oversees the work of the executives of the company, and they ensure that some wealth is generated to eventually be redistributed to equity holders. So, um, how are typically common stocks valued by investors? Because the value of a stock consists in a claim in the future stream of dividends, common stocks are typically valued as the expected present value of dividends. And when we talk about present value, we must talk about discount factor. So the discount factor is commensurate with the riskiness of the dividend stream. So if you invest in a company where there's a lot of risk and dividends are really uncertain, then you will use a higher discount rate than if you invest in a company where there's less uncertainty and you have less risk of not receiving future dividends. So when you hold a stock, there are two ways you can increase your wealth through that. The first way is through receiving dividend payments. So if, let's say, you purchase a stock, the company pays dividend, well, you will receive a portion of such dividends. So this is income for you. But and how are dividends elected? Well, it's the company which decides when and how much dividends are paid through time. Okay, so this is at the discretion of the company. The second way of earning value through holding a stock is if the stock shares value increases on the market. So for example, the company might operate and grow the value of its asset without immediately paying dividends to stockholders. So in that case, if the company grows its asset base and the value of its equity, then stock prices will go up, and the person who owns stocks will get wealth, will increase its wealth through that process. So if you own a stock, there are two ways you can increase your wealth, either through dividends payment, which are direct income, or through the growth of the value of the stock itself on the market. Okay, so we talked about common stocks. There are also what we call preferred stocks, which are another type of stocks. So preferred stocks are hybrid instruments which lie somewhere in between common stocks and debt. Okay, so they possess some features of common stocks, but some features of debt. So what features of debt do they possess? Well, first, they don't provide voting rights to elect the board of directors. So you have no control over the company if you hold a preferred stock. Second, the cash flows are often predetermined and set in terms of some benchmark interest rates, such as the LIBOR, which we discussed earlier. So unlike for common stocks where the dividends fluctuate through time, for preferred stocks, the value of dividend payments are often set in advance, predetermined in advance. However, the payments can be omitted by the company without legal consequences. So if the company doesn't repay its debt, it will go into litigation. But if the company doesn't repay payments or dividends associated with preferred stocks, there's no bankruptcy as a consequence. Okay, so in that sense, this is safer for the firm. And furthermore, if the So this is a feature of equity rather than debt. So payments or dividends are not mandatory. And furthermore, if the firm liquidates in the case of its assets in case of bankruptcy, then preferred stockholders have a higher priority than stockholders, but common stockholders, but a lower priority than debt holders. So let's say the company goes into bankruptcy, then the assets are liquidated, and the first people to be repaid are debt holders, then preferred stockholders, then common stockholders at the end. So we can see that uh, these preferred stocks lie in between debt and equity in terms of their features. So because of that, their expected return is usually lies somewhere between the return of common stocks, which is higher, and debt, which is lower. Okay, so we said that the payments or dividends to preferred stockholders are often predetermined in advance, but that their payment is non-binding to the company. So one might wonder, like, why would the company decide to repay its preferred stockholders if there's no legal consequences in not doing so, and if uh, preferred stockholders do not control the company? So why not just ignoring them and not repaying uh, the amounts that were promised to them? Uh, that's a good question. The answer to that is that for preferred stocks, there are often provisions written in the contracts that prevent the company to pay dividends to its common stockholders if the preferred stockholders were not repaid. Okay, so there's a provision saying, okay, if you decide to omit dividends to preferred stockholders, then you have to also omit dividends to common stockholders. And because it's the common stockholders who control the firm, they want to obtain their dividends. And to obtain their dividends, they must often pay the preferred stockholders first. So this is the reason why preferred stockholders are paid in practice. It's because otherwise the common stockholders will not receive their dividend payments, and the common stockholders control the company, so they want their dividend payments in practice. Okay, so again, this is a high level explanation. We don't dig into the details, but this gives a reason why these preferred stockholders are repaid in practice. Furthermore, if a company doesn't repay its preferred stockholders, it's not good for their credibility and financial reputation. So it might impair their ability to issue preferred stocks in the future. Okay, so retaining its financial credibility is very, very important for a company. So when you decide to omit payments you've promised, this hurts your credibility, and this prevents you from issuing or accessing capital in the future. So this is very important. So a third equity type that we will discuss now is private equity. So private equity is a form of ownership of the company, but which is not traded on public exchanges. So you cannot go to exchanges and say, I want to buy private equity. No, private equity are deals that are made privately to own some company, and they provide more direct control over the company. So typically there are very few owners of the company in a private equity deal, which is different than for public companies deal. So if you have common stocks, there are typically many owners of the company because many people hold stocks of that company. Whereas for private equity, it's typically a very small amount of specialized investors who will hold the company in that deal. So they provide capital to the company, and that capital provides them ownership of the company, and investors which provide that capital are typically a small number of investors. So in practice, the expected return on private equity is typically much higher than for common equity. Okay, because buyers of this type, private equity, they're more rare and they're more specialized investors, so they're harder to find in a sense, and it's much because it's private equity is not traded on public exchanges. These titles of ownership are less liquid. It's harder to get rid of them. So because of that, to be compensated for this risk of not being able to get rid of your investment when you want, then the investor must be compensated, and this is done through a higher rate of return. Okay, so typically private equity offers a higher rate of return than public equity. Okay, there are many ways to categorize private equities. Here are a few types of common types of private equity. So the first type we can discuss is venture capital. So venture capital is capital provided at a very early stage of the firm's life. Okay, so this is a high risk, high reward type of capital provided by the company. So when a company, for example, a young startup is very young, it can go try to ask capital from investors. And investors who invest in this, because the company is not mature, it's very young, they know that there's a very high risk. So they will provide capital, but if it doesn't work, they might lose all of their money. But if it does work, then they hope to reap a very large return on this. Okay, so venture capital, it's for investors at a very early stage at the company, which provide capital to own the firm. A second type of private equity that is commonly found is distressed capital or distress funding. So this is investors which purchase an underperforming company, typically facing bankruptcy, and they purchase that company and attempt to turn it around to improve its financial situation and health, so to return the company to some level of profitability and then profit from that deal. Okay, so distress funding is you buy companies that might be mature but which are underperforming with the hope that you can eventually make profit out of it if you improve the health of the company. And finally, a third type of private equity that is commonly found is called leverage buyout. So this is a group of investors which typically purchase a company or a firm using debt. So they borrow money from some financial institution. They use this money to purchase a company, and they hope to resell the company at a later stage at a higher price and reap some profit out of this deal. Okay, so of course we won't go in details through each of these types of preferred private equity deals, but this is just to give you an overview of the type of private equity deals that are made in practice. Okay, so we've seen many types of funding, but now we must ask ourselves, why would a company would go for debt versus equity, or why would it go, if it chooses debt, why loans versus bonds, or if it goes for equity, why common stocks versus preferred stocks versus private equity? What criteria does company use to choose the type of capital they want to access? Okay, this is a very exhaustive discussion. Some corporate finance classes address these type of questions, but here we will discuss one important factor in making this decision, which is the maturity of the company. So at an early stage, the company is not very mature. It doesn't have a very large credibility, financial credibility. So, because of its not yet established credibility, it's harder for the company to access public markets. So, typically, the company will secure private capital at this point. So, if it goes for equity, then it's typically private equity and private investors which will provide the capital, whereas for debt, typically the money is going to be borrowed through loans instead of bonds because loans are private deals also. Okay, so at an early stage of the life of the company, typically the company will access private sources of capital such as private equity and loans. Furthermore, when the company grows and reaches a stage where it's sufficiently mature, then it has the credibility to access public markets, so it will typically tend to get rid of the private source of capital funding and use public sources of capital funding to fund their operations. Okay, so for example, for equity, when the company becomes mature enough, it will issue some stocks on the public markets, which are purchased by public investors to replace private equity capital. So why would they do that? Well, typically it's because common stocks offer a smaller rate of return than private equity funds. So because they offer investors expect a smaller rate of return, they are ready to pay more for their equity. Okay, so public equity is typically less costly than private equity funds. So this is the reason why the companies go for this type of funding. Also, common stocks or public equity, they're more liquid, so you have access to a much larger pool of investors to obtain capital. However, this comes at the expense of additional regulatory burden. So when you participate to public markets and you issue stocks, you have additional disclosure requirements. So, for example, you must issue financial statements and etc. So you can access public sources of capital, equity capital, but if you do that, you have some more regulatory and or let's say administration constraints you have to satisfy to do that. For in terms of debt, when a company is mature, it typically replaces its loan it obtains from financial institutions with bonds that are issued on capital markets. So bonds, again, they're typically less expensive. No, sorry, I won't say that. So why do companies prefer bonds? It's because loans, we said that they can be restrictive in terms of the actions of the company. So, uh, like recall we mentioned that for when you subscribe to a loan to a financial institution, the financial institution first has access to some confidential about you, and they can put some constraints on your company's operations to prevent you from taking too many risks. Whereas bonds, bondholders, they didn't have this possibility of putting constraints on your operation. So because of that, when a company is mature, they tend to get rid of loans and replace them with bonds, which give them more flexibility. Okay, so now we will discuss what we call an IPO, or an initial public offering. Um, it's because we need to have a short discussion about how are um, stocks issued in practice. So when we say the company wants to access capital through equity, it must issue the stocks to the public market. So there are two types of issuance. The IPO, or initial public offering, it's the first time that a company issues public equity. So when it's initially private and it wants to become public and issue stock for the first time. So how it's done, typically it's investment banks which help the firm through this process by doing market discovery for them. So investment banks have many contacts with investors, so they can contact many investors and ask them, okay, if would you be interested in buying shares of that firm that is now attempting becoming public and is issuing stocks. And so once investment banks help the firm through this process, the company can issue stocks and sell the stocks to investors, and this is called an IPO. And the proceeds from that IPO, so the money paid by investors to hold the stocks, can be used by the company as capital. So once the IPO is done, the company is now publicly held instead of privately held. The company can still access equity capital at subsequent times by issuing additional stocks in the future. Okay, so if additional stocks are issued by a company, then this dilutes the shares of the current owners, because you now need to split the pie across more owners. So the ownership is diluted, but this allows the company to access additional capital in the future. Okay, so if you have a mature company, well, what we mentioned is that this company typically accesses public sources of funding through common stocks or preferred stocks that are issued to broad public markets, but it's not always the case. Sometimes some companies might prefer remaining private. So for a mature company, if they want to remain private, the alternative would be what we call a private placement. Okay, so instead, so at the beginning, the company is privately held, and even if when it becomes mature, it might decide to still remain privately held, and it can still access private equity capital by offering shares of the company through a small number of select investors. Okay, so these investors can be private, and why would the company want to do that? Recall that when you access public market capital and you issue stocks, you have disclosing and other types of regulatory requirements that you don't have when you're a private company. So if a company doesn't want to prepare financial statements and be faced with all that regulatory burden associated with public companies, they might decide to remain private. And so if they want to access equity capital but in a private way, then they can offer shares of the company or ownership of the company to specialized private investors. So this is called private placement. So one last thing we can discuss is if a company at some point goes public and issues common stocks, for example, in public markets, can it go back to a private state subsequently? And the answer is yes. So once a company becomes public, it can return to a private ownership at a later stage. And this can be done if some private investors they decide to buy all shares outstanding on the market. Okay, so this is referred to as a buyout of the company. A buyout means that some investors they decide some private investors they decide to purchase shares of the company and own the company as private investors. So I won't go into the details of that, but you might be wondering what happens if a very few number of investors or stockholders are unwilling to sell their share back to these private investors. Well, there's a way to squeeze them out legally and force them to sell the public shares to private investors, but I won't go into details about that. I'll let you look at the link provided in the footnote in this slide if you want further details about how this is done in practice. All right, so the last slide here presents some references I've used for this chapter. These are not scientific references. These are websites that are available to the public, and they are well done and very convenient source of information if you want to learn more about that. All right, so this completes chapter 0, which was much more qualitative than quantitative, and then the next chapter will be much more mathematical. So thank you. Have a nice day.